How to fill out the W-4 if you're married filing jointly and you plan to itemize. Now, I personally feel that there's a different way that you should consider. However, this is some people's situation, so let's dive in. I'm at the IRS website. If you want to access the W-4 withholding estimator tool, then all you do is scroll down to tools and applications. You slide over to the next to the last one, check your withholding. I'm going to go pretty fast just so the length of the video is not too long. They talk about how it works. We share that in several different videos, but when you're ready, you just select use the tax withholding estimator. Then you go here. It starts with the section about you. I told you this is married filing jointly. We'll select that. Do you or will you have a job that regularly withholds income taxes? Yes. Will you claim dependents? In this example, there are no dependents, so we're just going to hit next. Income when withholding. So, how many jobs will you and your spouse have this year in which federal income tax is regularly withheld, include past, present, and future jobs? It's two different ones, so we're just going to say each individual has one job, so we're going to put 2 jobs. First income source is an hourly job. Know the difference between each of the ones listed. If you ever have a question, you can click that question mark and it'll elaborate. This income source is for myself. We're going to click myself. The second one we'll do for the spouse. Select what best describes when you earn income on this job. They plan to have the job all year, so we're going to do all year. How frequently are you paid? In this one, we're going to say that they're paid twice monthly, on the 1st and the 15th. If it was every 2 weeks, it'll be every other Thursday, every other Friday. You get the point. Using your most recent check stub, when did your most recent pay period end? We're going to say that their most recent pay period ended on January the 31st. What was your most recent pay date? They get paid on the 1st and the 15th, so their most recent pay date was on February the 1st. Select the option that best describes your current situation. Last paycheck was a good representation of how much they earn every pay period. Yes, we're going to say wages per pay period for this person is $2,000. Enter wages earned year to date. They've been paid January 1st, January 15th, and February 1st. $2,000 each time they got paid, for a total of a year to date being $6,000. Based on the information provided, it looks like your total income from the job this year will be $46,000. Is this correct? We're going to say yes for this particular person. Enter federal paid taxes, or federal taxes paid per pay period. They get paid $2,000. Let's just say that every pay period they're taxed $200. Everybody's scenario is different. In this case, federal income tax paid year to date will be $600 because they've been paid 3 times. They've been taxed 3 times. All of these will stay blank for the sake of this example. Then enter your second income source. So we'll go ahead and click to drop that screen down. This is also an hourly job. This one is representing the spouse. The spouse plans to get paid all year. They also get paid twice monthly for the sake of this example, 1st and the 15th. We're going to say that their last pay period ended on January the 31st as well. And we're going to say that their last time getting paid was February the 1st. The spouse paycheck is a good representation of how much the spouse earns on average per pay period. Yes. Enter wages per pay period. So in this case, we'll say that this particular spouse earns, let's say $3,000 per pay period. Year to date, that means they got paid 3 times, so they've earned $9,000. So they got paid on the 1st of January, January 15th, and then February the 1st. So you get the math. Based on the information provided, it looks like your spouse total income for this job will be $69,000. Is this correct? Yes. Federal income taxes paid, we'll say that they paid, and these will typically vary. This is just example purposes only, but we're going to say they get taxed $300 per pay period. So year to date, they've been taxed $900, $300 per paycheck times 3, basically. From there, we're done with income. We're not putting in anything additional, but I want to show you what it looks like when a person is doing itemized. So withholding an estimated tax payment on other sources of income, we're not entering anything else, so we'll hit next. Now we're talking about the adjustments to income, student loan, educator deductions. We're not doing any of that in this example, but we'll hit next on this one, deductions. Now, standard or itemized deductions. We'll get back to this. I want to show you how it looks, then come back to this. Standard or itemized deduction reduce the amount of your income subject to tax. Most people take the standard deduction, but you may be itemizing your deduction if you have a mortgage, large gifts to charity, or large medical expenses. Your standard deduction amount is calculated to be $30,000. So the standard deduction is $30,000. So in order to itemize, you have to have itemized deductions that are more than $30,000 in order for it to benefit. This is why for most people it doesn't benefit them. And instead, what they should consider is having a business, an online business, some type of business that allows them to get access to hundreds of tax deductions. And in many cases, that helps them more than just doing itemized, because most people don't have enough to over or exceed the standard deduction. Would you like to see if itemizing deductions would be to your advantage? In this case right now, we're just going to say no, because we're going to come back to this. Tax credits. So we're not putting any tax credits in. I just want you to see what the results are. Okay, age. We'll say that the person will be 40 this year, and then the other person will turn 41. Just throwing some numbers out there because they needed that. Then we hit go, and it takes us to the final page. So let's see what that looks like. Based on the results, it says you're withholding more tax than you need from your paycheck. So it looks like they will end up paying $12,000 throughout the year if nothing else changes. If they don't adjust their W-4, nothing else changes. That's what they will end up paying, and their projected refund is $2,274. Well, they can increase their take-home pay by submitting a new W-4 form. And this right here tells you exactly what they need to do in order to do it. They can just download a pre-filled, or they can fill it out and adjust it according to the situation. It lets you know what adjustments need to be made in order to increase their take-home pay. So that's that. They're set to get a $2,000 plus refund. But let's see what happens if they did have itemizations available. So we'll go back to step number 4, deductions, itemized or standard deductions. So let's just say yes. Now, it says right here, if you hit the question mark, standard deduction is this, and it lets you know what standard deduction represents. But itemized deductions are basically things that you may qualify for in this list. So qualified mortgage interest, state and local taxes you pay, medical and dental expenses, gifts to charity, casualty losses, or other itemized deductions. And you can click and see what itemized deduction if you want to elaborate in that area. But if you know you have high medical bills, then you can enter, let's say medical bills, they had $25,000. Because remember, it needs to be more than $30,000 in order for it to even be relevant in terms of them claiming it. Then did it take me? Okay, I don't want to go to the next phase just yet, but $25,000 in medical deduction. Let's say their mortgage interest rate in expenses. Let's say that they had an extra $2,000 there. And then state and local taxes that they pay. Let's say they pay $6,000. I'm just coming up with some numbers. And this will put them over the $30,000 threshold. So let's see what happens when this takes place. Nothing else changed other than them having itemized deductions that exceeded the standard deduction. Keyword, it had to exceed the standard deduction. So let's see what happened. Your result, based on the information you entered, you're withholding more tax than you need from your paycheck. Expected tax withholding, if nothing changed, they're still going to pay in the $12,000. The anticipated tax deduction, if nothing changed, was $9,026. Projected refund, still the $2,200. So that's why I say a lot of times when you do the itemized, it might not benefit you as much as you think. Sometimes it may offset it a little bit, but it has to exceed it quite a bit. If this person would have had business deductions, which we went over in a different example, then this projected refund would have been more, because they would have been able to lower their tax liability and lower the amount that they were anticipated to owe. Basically, their anticipated tax obligation, which would have put more money back into their pockets and positioned them to get more money throughout the year. It's a critical strategy that when people understand how to legally minimize their taxes, keep more of their money. For some households, they can keep $1 million in taxes over their working career. Say they work 30, 40 years. And they were paying taxes normally without having this education. Now they put that money back into their household that can be used to build wealth and create generational wealth. So this is just a brief example. Definitely pay attention to what we have below in the description, where it elaborates on ways that you can legally minimize your tax liability and increase your cash flow, take full control of your finances. Hopefully this video served you well. Mr. Smith, signing out. Salute.